If you own a $10 stock and it's going to pay a $1 dividend and the stock price doesn't go up or down, the moment that dividend pays, the stock is no longer worth $10. It is immediately worth $9 because you owned something that was worth 10 and they paid you 1. So you now own a $9 stock. So just keep in mind that like dividends can be nice, but they aren't the end all be all. And I'm digressing really, really fast because I can do that when I talk about stocks.
All right, back to the top level. Yes.
Yeah, top level stocks. So stocks are risky, and they're the riskiest because you are the owner of the company, right? So think about instead if you are lending money to a company or a government. So if I go to Meg's company and I say, Meg, I want to invest in your company Flow, I want to expect a pretty high rate of return on that return for me to get my money back. So I need to see a good business plan and good strategies so that we can see that. And what are the cash flows been in the past? And what do we think is going to happen in the future? And it really is all about what's going to happen in the future for what do I think that rate of return is going to be? When we then go to look, if instead Meg comes to me and says, hey, can I borrow 50 grand from you instead of you investing 50 grand in my company? Well, I'm not going to expect the same rate of return because I'm going to expect that in 3 years, Meg's going to give me my $50,000 back. Right. So if I'm going to lend you 50,000 and you're going to give me 50,000 back, I don't need the same rate of return as I would expect if I'm going to be a stock investor. Right. It's not as risky because you're going to give me my money back. So we're inherently going to see the rates of return on bonds be lower than they're going to be on stocks, typically, is what we see. And that's what we see in markets.
Right. Because the risk is lower.
Right. And then when we look at cash, when we say cash, that you could invest in cash, what we're really talking about is investing in very short-term U.S. money, U.S. treasuries. So it's basically lending money to the United States government for 90 days or less. And then you can also do that to corporations through things called money market accounts. And those we're typically going to see even a bit less of a return as compared to bonds.
Yeah. And when I talk with my clients, and maybe this is just idiosyncratic to me, I don't even consider cash an investment. Like it's a tool, it's a financial tool, but I like to think about it. Investments are something that you expect an actual return from, and you're just not getting much of a return.
Yeah. And to be clear, I don't expect that. We don't invest in them in portfolios virtually at all either. We might carry like 0.5% of cash in portfolios for rebalancing needs, but we don't typically invest them. The reason I bring them up is because it is a choice that you can make of where do I want to hold a position.
Exactly.
And there's certain instances that we'll talk about where owning a cash position might make a lot of sense.
Absolutely.
So that's stocks, bonds, and cash. Then we think about stocks overall. Stocks are a huge, huge thing. There's over $81 trillion of stock available in the world, which is just like, I don't even think I can wrap my head around that number. But the U.S. is the biggest market. It's about 61% of the world market. And there's about 3,500 stocks available in the United States to trade. Right. And then you think about developed markets. That's like the UK and Australia and Europe and Japan. That's 6,500 companies, about $21 trillion and about 27% of the world. And then you can invest in emerging markets. So emerging markets are like China, Brazil, India, and that's 24 countries, about 10,000 stocks, and about $10 trillion, about 12% of the world. So there's all these potential areas to go and invest in. And oh my gosh, it's like, how do I choose where to go and what to do?
Yeah. And as complicated and daunting as that might sound for stocks, the bond markets are like an order of magnitude more confusing. Yeah. So we're not even going to attempt to go very deep with that. But I did want to call out that you had previously mentioned, getting a treasury bond, a U.S. treasury bond.
Yeah.
Right. And that's the kind of bond that gives you the safety that we look to bonds to provide. And I just want to contrast that to lots of things are called bonds and function as bonds. Like they're loans that you expect to be paid back and also get paid interest along the way. But you can invest in what are now called high yield bonds, used to be called junk bonds.
Yep.
And they in fact perform way more closely to the way stocks do. They have the same sort of risk characteristics as stock than they do to US Treasury bonds. So when we're talking about bonds, if you want bonds to play a role of low risk, sort of more of a guarantee you're going to get your money back, then you're really looking for safe bonds, Treasury bonds, or if they're bonds with companies like AAA, like a very highly rated, stable companies, not high yield bonds.